What if China's biggest challenge isn't the United States? What if it's China itself? For decades, experts predicted China would become the world's unquestioned economic superpower. But today, more economists are asking a different question. Has China already entered the beginning of its peak? By the end of this video, you'll understand the structural forces that could reshape China's future, and why the turning point is not one single crisis, but the moment several long-term pressures begin hitting at the same time. In 1978, China was impoverished, isolated, and largely shut out from the global economy. That December, Deng Xiaoping redirected the nation's focus toward economic development while maintaining strict Communist Party political control. This policy shift triggered a rapid chain reaction. On August 26, 1980, the government established 4 coastal special economic zones, including Shenzhen and Xiamen, to test foreign investment. These zones operated under market rules, offering tax incentives that attracted global corporations. The decision worked. Policy drew foreign capital. Capital built factories, and factories generated exports, rising incomes, and massive urbanization. When China joined the World Trade Organization on December 11, 2001, global trade accelerated. In just 3 decades, deliberate policy turned an agrarian nation into the manufacturer of the world. It stands as one of the greatest economic rises in modern history. But maintaining this immense momentum required a constant supply of young labor. In 1979, Beijing introduced the one-child policy to control population growth. Though relaxed in 2015, the demographic trajectory did not reverse. By 2025, annual births fell to 7.92 million, a record low since 1949. The fertility rate dropped to 0.97, far below the replacement rate of 2.1. This shifts the economic equation. China is rapidly aging while its working-age population shrinks, creating severe dependency pressure, meaning fewer active workers must support a growing pool of retirees through higher pension and healthcare costs. Unlike Japan, South Korea, or Europe, which became wealthy before their populations aged, China risks growing old before it gets rich. A shrinking workforce threatens to stall its economic engine before it ever reaches high-income status. While demographics shifted in the background, Beijing relied on an entirely different engine to power its GDP: real estate. At its height, property and construction drove nearly a quarter of the economy. It became the primary store of household wealth, while local governments depended on land sales for half of their fiscal income. To sustain this boom, developers borrowed aggressively, overbuilding in cities that struggled to find residents. Then, the debt-fueled model broke. In December 2021, Evergrande, saddled with over $300 billion in liabilities, defaulted on its debt. The collapse left more than 1,300 unfinished housing projects across 280 cities. A severe chain reaction followed. Falling home sales halted construction, shaking consumer confidence and slashing local government revenues. Because building another high-rise eventually creates less value than building consumer confidence, this freeze did more than stall construction sites. It locked up household wealth and strained bank trust. The country's primary growth engine had turned into its most persistent economic drag. To offset this drag, Beijing historically turned to a reliable stabilizer: massive infrastructure spending. For decades, local governments used specialized financing vehicles to borrow trillions, building roads, bridges, and industrial zones that guaranteed immediate GDP growth. But this strategy has hit a wall of diminishing returns. Easy expansion opportunities have vanished, leaving many regions facing severe fiscal pressure. To escape this trap, China must undergo what economists call rebalancing, meaning the economy must transition from being driven by state-led construction to being powered by household spending. But this shift is incredibly difficult. Chinese consumers remain deeply cautious, saving a massive portion of their incomes because a limited social safety net forces families to self-insure against future healthcare and retirement costs. This caution paralyzes the new economic model. The old playbook of debt-fueled investment no longer works because building another highway eventually creates less value than building consumer confidence. Instead, local authorities are left with mounting debts, while the domestic spending needed to replace construction remains frozen. If assembly lines define China's past, future expansion belongs to a different arena. Semiconductors, artificial intelligence, robotics, quantum computing, and advanced manufacturing. The contest has shifted. Dominance now depends on controlling the digital foundations of the next century, rather than manufacturing cheap goods. In this environment, massive pools of low-wage labor offer little economic advantage. To contain this transition, Washington imposed sweeping export controls on advanced microchips, restricting access to the frontier inputs needed for supercomputing. Beijing countered by launching an aggressive self-reliance campaign, mobilizing 500 billion yuan through policy banks to build over 30 new domestic chip fabrication plants. While global restrictions constrain near-term access to international tech, they also force rapid local breakthroughs, driving Chinese firms to build entirely independent supply networks. This technological separation creates a high-stakes trade-off, testing whether state-directed capital can construct a resilient technological ecosystem from the ground up. Which challenge do you think matters more for China's future? Demographics, debt, technology, or geopolitics? Comment your answer below. Global boardroom strategies are shifting under the weight of rising Chinese labor costs, tariffs, and pandemic-era disruptions. This has accelerated the China Plus One model, where multinationals establish secondary bases in Vietnam, India, Mexico, or Indonesia. While foreign firms are not leaving China entirely, their reliance on its manufacturing base is no longer automatic. Inside China, this global shift intersects with a strategic trade-off. The Communist Party is taking a more active role in directing the economy, channeling state credit toward national security and strategic industrial priorities. This top-down coordination can mobilize immense resources at speed. But tighter state control also introduces regulatory unpredictability. For the private sector, which generates most of China's jobs and technical progress, these shifting rules have begun to chill entrepreneurial risk-taking and domestic investment. The result is a delicate balance between state-driven stability and market-led growth. This balance also extends beyond domestic borders. To protect its interests, Beijing has modernized its military, building a massive blue water navy and expanding its security footprint in the South China Sea and Taiwan Strait. Abroad, the Belt and Road Initiative has funneled over $1 trillion into global infrastructure, securing trade routes and diplomatic partners. But this expanded global reach carries significant economic costs. Funding a global presence diverts critical capital away from domestic restructuring, while growing rivalry between the US and China and regional disputes trigger trade restrictions, foreign defense countermeasures, and costly diplomatic pushback, testing whether geopolitical ambition might ultimately cap economic growth. Historical parallels offer a map, not a perfect prediction. Japan after 1990 remains the most relevant comparison. There, rapid growth, an asset bubble, and swift aging appeared together to trigger prolonged stagnation. Some observers point to the Soviet Union, but that rigid command economy lacked China's global market ties. Yet, China also lacks the structural buffers of the United States, such as massive capital markets, high immigration, and reserve currency dominance. This leaves Beijing confronting the middle-income trap, where developing nations stall before becoming fully high-income. The question is whether China can keep moving up the value chain or simply flatten out. Yet, China is not without powerful levers. The nation controls 60% of global electric vehicle sales and 75% of battery production, backed by 50,000 kilometers of high-speed rail. Each year, its universities graduate 1.3 million engineers, fueling a massive domestic market capable of rapid technological adaptation. But the core challenge is not a single isolated crisis. Instead, it is the simultaneous convergence of demographic decline, systemic debt, property stagnation, and rising technology restrictions. This overlapping pressure limits the effectiveness of traditional state-led fixes, leaving the country's economic trajectory fundamentally uncertain. Today, Beijing is attempting to rewrite the laws of economic gravity. How it balances state control with the raw innovation needed to grow will shape the global order for decades. China's ceiling is now the world's ceiling. Subscribe for more geopolitical deep dives.